Welcome back, students. I hope you're all ready to dive into Chapter 5 of the Conceptual Framework for Financial Reporting. In this chapter, we will be covering the important topics of recognition and derecognition. Here's what we will explore. 1. The recognition process. Understanding how and when items should be recognized in the financial statements. 2. Recognition criteria. Relevance. Ensuring the information provided is useful for decision-making. Existence uncertainty. Handling situations where there's uncertainty about the existence of an item. Low probability of an inflow or outflow of economic benefits. Dealing with items that have a low chance of resulting in economic benefits. Faithful representation. Ensuring that recognized items accurately reflect the economic phenomena they represent. Measurement uncertainty. Addressing issues related to the accuracy of the measurement of recognized items. Other factors. Considering additional elements that may affect recognition. 3. Derecognition. Understanding when and how to remove items from the financial statements. The content of this chapter is very important, and we will explain each subject in detail, providing examples to ensure that everyone understands it. Let's get started and make sure we grasp these essential concepts thoroughly. Overview of the recognition process. The recognition process in accounting ensures that items are correctly included in financial statements. This involves checking if the item fits the definition of a financial element, determining if it will likely bring future benefits or costs, ensuring its value can be measured accurately, and then recording it properly in the financial statements. Steps in the recognition process. 1. Definition. Check if the item is an asset, liability, income, or expense. Example, an asset is something valuable that the business owns, like equipment or cash. A liability is something the business owes, like a loan. 2. Probability of future economic benefits. See if it's likely that the item will bring in or cost the business money in the future. Example, for an asset, this means it will likely help the business make money. For a liability, this means the business will probably have to pay money. 3. Reliable measurement. Make sure you can accurately figure out how much the item is worth. Example, this means you should be able to use invoices, market prices, or other evidence to prove the item's value. 4. Criteria satisfaction. Confirm that both the probability of future benefits or costs and reliable measurement are met. Example, both these checks need to be satisfied before the item can be recorded in the financial statements. 5. Initial recognition. Record the item in the financial statements at its initial cost or value. Example, when you first record the item, use its purchase price or fair value. For example, if you buy a computer for the business, record it at the purchase price. 6. Subsequent measurement. Update the item's value in future financial statements. Example, over time, adjust the item's value as needed. For example, reduce the value of a piece of equipment as it gets older, depreciation, or adjust the value of inventory if it loses value. By following these steps, you can ensure that your financial statements are accurate and provide useful information for decision-making. Purpose of financial statements. Explanation. Financial statements summarize an entity's recognized financial items in a structured way, making them easy to understand and compare. The amounts included in these summaries form totals and subtotals, linking related items. Example. A balance sheet shows all the company's assets and liabilities, allowing stakeholders to see the total equity and assess the company's financial health. Linking elements. Explanation. The balance sheet and income statement are connected. Total assets minus total liabilities equal total equity. Changes in equity include income minus expenses, contributions from and distributions to shareholders. Example, if a company earns $10,000 in revenue, income, and has $7,000 in expenses, the net income of $3,000 increases the equity on the balance sheet. Interconnected recognitions. Explanation. Recognizing one item often affects others. For example, recognizing income might mean recognizing a new asset or reducing a liability. Recognizing expenses might mean recognizing a new liability or reducing an asset. Example, when a company provides a service and earns revenue, it recognizes income. This might also increase the cash asset if the customer pays immediately. Simultaneous income and expense recognition. Explanation. Sometimes, recognizing new assets or liabilities leads to recognizing both income and expenses at the same time, like when selling goods for cash. This matching of costs with income happens naturally, but is not the main goal. Items must meet specific definitions to be recognized. Example, when a store sells inventory for cash, it recognizes income from the cash received and an expense for the cost of the inventory sold, matching the income and expense in the financial statements. In short, the recognition process ensures that financial statements accurately reflect an entity's financial position and performance by including items that meet specific criteria. Let's go through the recognition criteria in detail, ensuring we capture all the essential points. Overview. Recognition in financial reporting involves determining whether an item meets the definition of an asset, liability, equity, income, or expense, and whether it satisfies specific criteria. Recognition is crucial as it ensures that financial statements provide relevant and reliable information to users. The main considerations for recognition include relevance, existence uncertainty, the probability of inflow or outflow of economic benefits, faithful representation, measurement uncertainty, and other factors. Hash subtitles explained. 1. Relevance. Information about assets, liabilities, equity, income, and expenses is considered relevant if it can influence the economic decisions of users. However, simply meeting the definition of an asset or liability does not automatically imply that recognizing it will provide relevant information. Example, if it's uncertain whether an asset exists or the probability of an inflow or outflow is low, its recognition might not be relevant. For instance, a potential future lawsuit with a very low probability of resulting in a liability might not be relevant to recognize immediately. 2. Existence uncertainty. Sometimes, it's uncertain whether an asset or liability exists. This uncertainty can be due to legal disputes, regulatory approvals, or other conditions. In such cases, the recognition of the item depends on the likelihood of its existence. Example, if a company is involved in a legal dispute over a patent, the uncertainty about whether the company will retain the patent, an asset, might prevent its recognition until the dispute is resolved. 3. Low probability of an inflow or outflow of economic benefits. Even if an asset or liability exists, if the probability of an inflow or outflow of economic benefits is low, recognizing the item might not provide useful information. Information about the magnitude and timing of possible inflows or outflows might be more relevant. Example, a company may have a contingent liability from a lawsuit. If the likelihood of losing the case, and therefore having to pay, is very low, it might not recognize the liability, but instead provide information about the potential outcome in the notes. 4. Faithful representation. Recognition should provide a faithful representation of the item, meaning it should be complete, neutral, and free from material error. This includes ensuring that the depiction of the asset or liability is accurate. Example, if a company sells a piece of equipment but retains significant control over its use, recognizing the sale might not faithfully represent the transaction. The company might need to continue recognizing the asset or provide explanatory information. 5. Measurement uncertainty. High measurement uncertainty can affect the decision to recognize an asset or liability. If the measure is subject to significant uncertainty, it might not provide a faithful representation. Example, estimating the future cash flows of a highly speculative investment might have such high uncertainty that recognizing the asset could mislead users. Instead, providing detailed notes might be more appropriate. 6. Other factors. Other factors influencing recognition include cost constraints and the need for explanatory information. The benefits of recognizing an item should justify the costs involved in measuring and reporting it. Example, If the cost of measuring a particular asset is prohibitively high compared to the benefit of the information it provides, the entity might decide not to recognize the asset. Conclusion. Recognition in financial statements involves ensuring that only relevant, faithfully represented, and accurately measured items are included. This requires careful consideration of relevance, existence uncertainty, probability of economic benefits, faithful representation, measurement uncertainty, and other factors. By adhering to these criteria, entities can ensure their financial statements provide useful and reliable information to users. Derecognition is the process of removing an asset or a liability from a company's financial statements. This usually happens when the company no longer controls the asset or is no longer obligated to pay the liability. When does derecognition happen? Derecognition typically occurs under these circumstances. For an asset, it is derecognized when the company loses control over it. For a liability, it is derecognized when the company no longer has an obligation to pay it. Accounting requirements for derecognition. The goal is to accurately show any assets and liabilities the company still holds after the transaction, how the transaction has changed the company's assets and liabilities. Steps in the derecognition process. Remove expired assets or liabilities. Derecognize any assets or liabilities that are no longer valid and record any resulting income or expenses. For instance, if a company pays off a loan, it should remove that liability from its financial statements. Continue recognizing retained assets or liabilities. Any parts of the assets or liabilities that are still held by the company must be recognized separately. For example, if a company sells a building but retains the right to use part of it, the retained part should still be recorded. Presentation and explanation. Clearly present and explain any remaining or removed parts in the financial statements to ensure transparency and accuracy. Special situations. Retained control. Sometimes a company might appear to transfer an asset but still controls it due to significant risks or rewards associated with it. For example, if a company sells a machine but still benefits from its use and bears the risks of its loss, it should not derecognize the machine. Agent situations. If a company transfers an asset to someone who holds it on behalf of the company still controls the asset and should not derecognize it. An example is transferring inventory to a sales agent. The company still owns the inventory until it is sold. Challenges in derecognition. Misleading financial changes. Derecognition should not misrepresent the financial position of the company. For instance, if a company sells an asset but retains an obligation to buy it back, removing the asset from the records may not fully represent the situation. If the company still faces significant risks associated with the asset, it might need to continue recognizing it. For example, if a company sells a receivable but guarantees it will be paid, it still bears significant risk and should evaluate whether to derecognize the receivable. When removing is not enough, keep recognizing the asset or liability. In some cases, the company should continue to recognize the transferred part to avoid misleading financial statements. For instance, if a company sells a piece of equipment but still uses it under a lease, it might need to keep recognizing the equipment. Treat proceeds as loans. Money received or paid during the transfer might need to be treated as a loan rather than as income or expense. For example, if a company sells inventory but has an agreement to buy it back, the proceeds might be considered a loan. Contract modifications. When a contract is changed, consider removing rights or obligations. Follow derecognition steps if the change removes existing rights or obligations. For instance, if a company modifies a loan agreement to eliminate some payment obligations, it should derecognize those obligations. Adding new rights or obligations. Decide if the new parts are separate or part of the existing ones. For example, adding new payment terms to a contract might require recognizing new liabilities. Extensive modifications. If the contract changes significantly, it might be necessary to treat the change as creating new assets or liabilities and derecognize the old ones. For example, if a lease contract is modified to change the leased asset, the company might need to recognize a new lease asset and liability. Complex transactions. Some transactions involve multiple components and need careful evaluation for derecognition. Example, selling a receivable but providing a guarantee involves checking if control of the receivable is truly transferred, the extent of risk retained by the guarantee, how the transaction impacts the financial position. Steps. Assess control over the asset to determine if it should be derecognized. Consider retained risks to ensure that financial statements accurately reflect the company's exposure. Ensure accurate financial representation by providing necessary explanations and presentations in the financial statements. By following these simplified steps, companies can ensure that they accurately reflect their financial situation when removing assets and liabilities from their balance sheets. Summary of Chapter 5, Recognition and Derecognition in Financial Reporting. Overview. Chapter 5 of the Conceptual Framework for Financial Reporting provides guidance on the recognition and derecognition of elements in financial statements. This ensures that the financial information presented is relevant, faithfully represented, and useful to users. The recognition process. Definition. Recognition involves including items in the Statement of Financial Position or the Statement S of Financial Performance if they meet the definitions of assets, liabilities, equity, income, or expenses. Items are depicted in these statements in words and monetary amounts, contributing to the totals of those statements. The recognized amount of an asset, liability, or equity is known as its carrying amount. Linking statements. The Statement of Financial Position and Statements of Financial Performance depict recognized items in structured summaries, enhancing comparability and understandability. These summaries link the elements of financial statements. For example, changes in equity during a reporting period reflect the income and expenses recognized in the Statements of Financial Performance. Simultaneous recognition. Recognition of one item often necessitates the recognition or derecognition of another. For instance, recognizing income may involve recognizing an asset or derecognizing a liability, while recognizing expenses may involve recognizing a liability or derecognizing an asset. Recognition criteria. Meeting definitions. Only items that meet the definitions of assets, liabilities, equity, income, or expenses are recognized. Recognition must provide useful information that is relevant and faithfully represented. Relevance and faithful representation. Recognition provides relevant information if it offers insights into an entity's financial position and performance. Faithful representation requires accurate depiction of recognized items, even if they involve estimation. Cost constraint. The benefits of recognizing an item should outweigh the costs. Judgment is necessary to determine when recognition is appropriate, considering the item's nature and circumstances. Relevance. Useful information. Information about assets, liabilities, equity, income, and expenses must be relevant to users. Recognition might not provide relevant information if there's uncertainty about the existence of an asset or liability, or if the probability of economic benefits is low. Existence uncertainty and low probability. Uncertainty or low probability of inflows, outflows doesn't automatically negate relevance. Additional explanatory information might be needed. Faithful representation. Measurement uncertainty. Estimates are essential, but must be clearly described and explained. High measurement uncertainty might affect the faithful representation of items. Sometimes, information accompanying uncertain measures can provide a more faithful representation than the measure itself. Other factors. Faithful representation also involves considering related assets and liabilities, presentation, and disclosure. Derecognition. Definition. Derecognition involves removing an asset or liability from the Statement of Financial Position when it no longer meets the definition of an asset or liability. For assets, this usually occurs when control is lost. For liabilities, it occurs when the obligation no longer exists. Achieving aims. Derecognition should faithfully represent the change in the entity's assets and liabilities. Procedures may involve separating retained components, presenting changes in performance, or providing explanatory information. Complex transactions. If derecognition implies significant changes, other methods might be necessary to faithfully represent the entity's financial position. Conclusion. Chapter 5 elaborates on the principles of recognizing and derecognizing elements in financial statements to ensure that they present relevant, faithfully represented, and useful information. Accurate application of these principles supports the reliability and transparency of financial reporting. Thank you for watching this lecture on Chapter 5. I hope you found it informative and clear. Don't forget to subscribe and like the video, and I look forward to seeing you in Chapter 6.